All right, good morning, everyone. Welcome to the Hurley Investments Trade Fine Adjustments for, it's August 26th, Thursday morning. I've got a couple things I want to show you today, and then we're going to go over a couple portfolios and things that I think we're about ready to do or change. So with that said, guess what? COVID hospitalization surged the highest on record in U.S. as doctors brace for more. I'm going to be a little political. When Trump was president, it was all his fault. COVID was ridiculous, even though he's sending our military ships out to New York to try to help out and everything. And this time around, with Biden as president, we don't hear any of the blame game. So I'm just going to make the comment that I'm not much of a conspiracy theorist. I think you have to watch what you say. But what bullshit it is for the news to no longer be reporting accurately or non-biased is what I'm going to say. And that bothers me. That bothers me because I don't think that is fair. I don't think it is accurate the way news is portrayed nowadays. And I think that bias on news affects investors. I think if we don't know what to think and we're fed a bunch of poor information, it makes it really, really hard to make good educated decisions on what you're going to trade and how you're going to trade. And for that to be happening, makes it difficult for the individual investor who does not spend nearly enough time doing their research from reputable companies, or doing their research and finding out that the company might not be as reputable as they believe. So with some of that said, in fact, it's kind of funny. Let me read two comments that just came out. Been going on for years, news reporting. Kevin, in all reality, the news hasn't been 100% accurate for forever. So to both of you, I somewhat agree and I somewhat disagree. But I think through Trump, I think we've kind of seen to the scope of maybe just how crooked our own politicians are. I think some of us, myself included, lived in the bubble that the United States was definitely better than Mexico and Brazil, and we don't have near the corruption that those governments do. I've lived down in Brazil for years, and I knew how to grease the system, so to speak. Yeah, I'll admit it. I'm pretty disappointed. We are not necessarily better, and we could be a hell of a lot worse than what we think is out there in other countries. Kind of foolish for us to think we're the best country in the world when it comes to political honesty, because that's just not true. But I'm relating this to understanding of how it affects our stock market. Last year, we went through a 28 to 34% drop. And it was due to a COVID going to kill people type of mentality, and our markets dropped like there was no tomorrow. Well, now COVID is the worst that it's ever been, and our markets are slowly going higher. So it's I'm not trying to be political to choose one side or another or talk about conspiracy theories. I'm just showing to you the effects that reporting and scare factors are used that manipulate markets, especially the ones that we're in today and that we've been in the past. So for that matter, understand COVID hospitalizations surged to the highest as ever before. More coming in. Our ICU units are being basically overrun, which what does this mean? You probably are not going to be investing in hospitals again or medical, because you're not going to see the surgeries that are not I forgot what they call them, not mandatory surgeries, but the surgery is not necessarily to save your life, but to better your health, are just not going to be available as hospitals fill up with more COVID patients. So again, relating that to the market, healthcare is not an area you're looking to be in right now. These elective surgeries that hospitals make their big money on are not going to be available to boost their bottom line and to goose their profits. So pay attention to this. It's something that I think is important. I think it's important to understand just how the news is affecting our stock markets and the trades you may be putting on. Now, we've got a good group here today. We're up to 13 right now. You have heard me talk about banks and for forever. And I know a couple of you have been on my banking bandwagon, but can someone please tell me or type in, what is my belief on banks and what will push banks higher in the future? And of course, what's going to push the banks higher, as I give you a hint, what will push those banks higher will also most likely drop the stock market. Because I've got two articles I want to talk about and show you in regards to that. But someone please tell me, what is Kevin Hurley's belief on banks and the catalyst or the push that'll continue to move those higher? And it looks like William, correct? William says higher interest rates. So why are higher interest rates going to move banks higher? I've said it quite a bit, but I want you guys to think, why am I saying, hey, higher interest rates are going to move banks higher? Rising interest, there you go. More profit, they're going to get to charge more. So there's a spread, there you go. William, excellent. There's a spread between the interest rate charge and the real charge that the banks tack onto it. The higher the interest rates, the bigger the spread or the potential profit it is to be available. I found it interesting because Bullard today, and the reason why our stock market's down, Bullard says the Fed has to get going on the taper, may need to get aggressive to stop inflation. We had a pretty good opening and we had an opportunity to really have a good day today. But one of the Feds came out, who's not the chair, but he is the Fed chair for St. Louis, but he's not the chairman of the Fed, came out and he said, hey, central bank should have his tapering process finished by the end of March. It means we need to be super aggressive to tame the current inflation that we have. So here we're being told inflation is transitory. So most of us have bought tips and we're thinking, okay, it's just a short period of time. We don't need to worry about it. And then we have one of the Fed members come out and say, oh, we're screwed. We've really got to jump on tapering our bond buying and ending, for all intents and purposes, ending the Fed stimulus to our economy because it's going to be in a bubble. And it's funny, it's already in a bubble. The Fed has spent trillions of dollars backing our housing market. It is the reason why we have seen home prices artificially inflated. In fact, I keep trying to tell my wife, if your home is your investment, this is when you need to be selling. You're not going to see home prices this high probably for the next 15 to 20 years. Well, Kevin, how can you say that? Well, if you run the backing or the trillions, the $6.4 trillion of bond stimulus If you run that out, that's running that out over roughly about a 16-year period of time of extra home purchasing or home buying that's been made, in which case it's like we just got a 16-year boost of home buying or home purchasing that, again, are not real numbers. It's Fed stimulus. We have stuck trillions of dollars to the housing market, in which case we're seeing ridiculously priced homes because we've goosed the home purchasing market in 4 years as of 16 years of home purchases have occurred. That's not just accurate. So again, to taper off on that and to see home prices move, it's ridiculous. We're going to have a serious misunderstanding of these home prices and just how much it's going to affect our stock market and the real, accurate price, of homes, which is unfortunate. It's unfortunate because for crying out loud, we should have a better understanding of what's moving our home prices and why. Okay. I made the comment on the banks, though. And banks are rising interest rates worry and banks were going down. So I thought it was just funny because I've been trying to find you guys information on, hey, banks are where you should be. They're undervalued. Banks with rising interest rates are really going to take off. And I found it hidden in today's article. Jim Cramer says, run with the bulls and buy these winning stocks. With all due respect, he's not the smartest. Semiconductors, and so he tells you to run with NVIDIA. Financials, and oh my gosh, look what we hear. I love it. It's right here, right? Many of the country's largest banks offer investors the greatest bargains relative to the rest of the stock market, Cramer said. That's especially true when considering they could be just a few months away from a new rate hike cycle, Cramer said. Banks benefit from higher rates. We finally have someone that says, hey, here we go. We're good to go. But again, I don't want to call him an idiot, but his favorites right now are Morgan Stanley and Wells Fargo. Well, Morgan Stanley is not a bank anymore. It's a wealth advisory service. So please tell me, someone please tell me, if you're a wealth advisory service, interest rates are going higher, we're at all-time highs for people that are borrowing money to be in the stock market. How the hell does that help wealth advisory or investment banking, as people are going to be putting more money to work now with higher interest rates? Not smart. Then he's telling you Wells Fargo, which really should benefit from higher interest rates because they're basically the leader in residential and residential home loans. So they're going to have a bigger spread to make more money on interest rates for new homeowners. But he chose the one that's so riddled with scandal and screwed up years. And I'll be honest with you, their current CEO is not necessarily making it better. He's just putting out fires. There's no betterness in their business model right now. It's a joke. It's a joke. Yet he says Wells Fargo could return to the high 50s. Out of curiosity, I wonder where Wells Fargo is trading at right now. Let's take a quick peek. Let's do Wells Fargo Company. So it's trading at 49.39. So Kramer's looking for a 20% return as Wells Fargo goes up, and he thinks that's a great return for just being a stock picker on a stock that maybe has the ability to go up somewhere between 16 to 20%. And I kind of giggle. I kind of giggle because, I don't know, at Hurley Investments, we don't necessarily call that a great return, do we? Which brings me to, if I was looking at something today, if I was going to be putting on a trade, my belief is it's time to enter into Baidu positions. And I will see if I can't find why I said that, but I thought I put myself a pretty interesting article. See if I'll be able to find it. Which I'm not going to really quickly, but the short answer is we have the opportunity with China kind of laying off. And if you look at a chart on Baidu, we've got some pretty neat opportunities to return to some all-time highs since it didn't. The regulation and all the punishment you've seen from Baidu wasn't their fault. It doesn't relate to them. It's going to be interesting for me to see, and I made the comment on Monday. My belief is Baidu can at least get back up to that 50-day simple moving average. And that 50-day simple moving average is sitting at 172.75. It was up at 174 when I mentioned it. Well, it looks like we're having a little trouble getting above 160, so there might be some buy or sell orders there. But I thought we'd get up to that 50-day moving average and that medium pivot point, which sits at 174.19. That's where I think we're going to be heading pretty quickly. Boy, we had a huge jump to go from 35 up to 55, $20 on a $135 stock. You know, that's about a 17.5% return. Pretty good movement in 3 days. Well, we'll call it a week. But I'm going to call it 3 days. Well, I guess it's 4 days, right? Pretty good movement. Look at that opportunity again, looking where Baidu has been and where it can get to. Not only that, but Kathy Woods is coming back into her heyday, started to buy some JD.com, which means what should follow: Tencent, Baba, Baidu, IQ. So we had that opportunity where, again, maybe not one of the smartest hedge funds, but someone that has a ton of money has the opportunity to affect these stocks, and she's been a fan of the Chinese stocks. It's where she's made her bread and butter. So it'll be interesting to see if we can't get the move on Baidu. I mean, really, I could have shown you earnings, and I guess I can show you earnings. We have a PE ratio right now, and a forward P of 7.94 and 14.28. Anyone have a general idea on comparables or where we would typically see a technology type company where their PE would be? Any idea? Where would you consider a pretty standard PE to be for a tech company? Because it's rather important to know that if you're going to be able to justify the price of a company. So there we go. All right, now I see some numbers. Closer to 30. Bingo. I see a bunch here that said 60, but that was in the past, and that's probably overpriced. Most technologies run on the high side of the S&P 500, which right now has like a 29 PE. So I would be saying a 30, a 32, maybe a 34. Let's go with the 32. So this is how you find if a company is undervalued. Earnings next year, 1087. You multiply that by the earnings or the PE ratio that you think is standard. We're deciding to choose 32, right? Right in the middle. 32 times $10.87 gives us a fair value stock price of $347.84. There we go. This is research. This is what we're looking for. Are they heavy on debt? Nope. Dirt cheap. Do they have a large float? Or is there a float ratio that is relatively high, above 1%? Yep, it's sitting at 3.11%. A float ratio usually justifies upwards to a 20-25% rise in the stock if it's 1% or higher. We have a 75% rise in the stock. Doing some more math, looking at a stock that's trading at 155, multiply it by itself plus a 75% gain just based on the short float. 155.78 times 1.75. This comes up with the price somewhere in that 272 range. This is why we're in Baidu. The fundamentals are amazing. They're a profitable company. Their book share, their cash, or just the value if you sold everything off, is $101. Their cash in the bank per share is half of the value of the stock. That's ridiculous. It should be down at 10%. Fundamentally, these are huge opportunities in a stock, in a position. This is the research that we do to justify some of the positions we're in. It's why we've been in banks. It's why we've been in Ford. It's why we're in Apple, why we're in Visa over MasterCard, American Express, Discovery. We run these numbers so that we have real data to back up our decisions on what we're in. The problem is there are times when the stock market isn't keeping up with fundamentals. There are times when stocks will act irrational and their fundamentals will not justify their price, or they will justify it and the stock won't be there. If we take a quick peek, 320, 270, 264, 260, 286. So these three are all coming down from 300, 330, 335, 325, 305, 292. I mean, we have an understanding where these numbers are right in between our numbers. And you know what's amazing? You don't have to be an analyst to figure these out and to do exactly what they're doing to come up with their numbers. It's all listed right here for you. You can do all of your research to see, hey, you know what? Their PE is a 7.94. As I asked the comments, and I'm going to give kudos to Jim Kohler here, rather new, hasn't gone through a bunch of education, but at least he knew, hey, it's going to be slightly above the S&P PE, which is all the way up at 29, right? Hey, you multiply the PE times the earnings per share next year, it gives you a price target of $347.84. Hey, you take the short float. 1% short float can justify a 25% increase in the stock. If you have 3%, all we're doing is taking the current price, multiplying itself, plus 25% possible increases, we come up with the price target of $272. This isn't rocket science. These analysts that are speaking these fancy terms are doing simple math to come up with everything I just showed you here. And it's something you can do yourself. Please don't think these people have some huge amount of brains or some huge amount of purchasing or insider trading knowledge. None of that's true. They're just a bunch of dummies that can subtract and add, multiply and divide, and that are listened to because they work for a bigger company. They've got no clue what they're talking about over anyone else. It's just simple math. It's simple math, and at Hurley Investments, we do that same thing here all the time. So our expectation is time and positions on Baidu. Now is the time to look to dollar cost average some 2023 opportunities, even if it creates more risk in a trade. And you'll be off to the races. If I was going to look at some of the things I might be doing here in the very near future, let me pull up my little slush fund here. Let's find the slush fund trust account where I do some of my stuff for you guys. If I was looking at my Baidu calls, these ones are not risk-free. These ones have about $12 of risk in them. Cost basis of 35, 281 is where I can buy them. I'm going to nibble. And so I'm going to adjust these ones. And instead of selling them, I'm probably going to buy. I'm going to be a little on the cheap side. I'm going to buy these to do a little dollar cost averaging. Let me show you what that would do to the cost basis. 35.31, 289. I'm doing equal contracts, so all you have to do, 35, I'm going to change that to 32. I'm going to round up. I'm going to take the 289. I'm going to make that add $2.90. When you add these together, they come out to 38.22. We're going to have 2 shares now, so we divide that by 2. And your new cost basis on paper here is $19.11. The good news is we've knocked down this price down to $12.60. Well, Kevin, why doesn't it say $12.60 as your cost basis? Well, because those were other trades that knocked down this price. This particular trade is down significantly. It's down to $2.90 on average on a $35 spend. Because we had long puts and short calls and other things to knock it down, the real cost basis is $12.60. Well, Kevin, it doesn't say that. No kidding, it's not supposed to say that. You have to use GAAP accounting principles. Those other trades were already closed. They are a closed order, so they are a booked profit. On a booked profit, you have to pay taxes on them. We can't do Chinese accounting here. We got to do real accounting. So real accounting on this position, if I was to close it down, it would be a loss for you. That loss would offset those profits you made. But right now, the cost basis of the January 23 300 to 350 calls is down to $12.60, down from 35. Yes, we've made up roughly $19 of the downward movement from 35 down to $2.89. To put that in perspective, $32 drop, we made 19 of it. It's about 2/3, a little bit under. So I'm willing to dollar cost average and to help out the 350s. On the 240 and 250 leap calls we have to 2023, those are 100% risk-free. So if I was going to work on those ones, let me pull up No Parker and erase this. Give me a quick second. Let me grab No Parker in here. No Parker, where are you? So we're going to be looking at this more towards the end of today, but all of these January 250s, the 240s, we've got a bunch over here as well, multiple accounts 250s. All these that are $62 that we spent 47 on, that we spent 67 on, these are all risk-free. In fact, they have the 250s have $3 of profit, the 240s have $6 of profit. The short calls we took against these guys have already made these 100% risk-free. We're playing with the house's money. I do think it's going to be time coming here very quickly to add $9.23 of risk, to add, excuse me, that's $8.92 of risk, $9.72 on the 240s. It's time to add a dollar cost averaging opportunity on these positions. And to do so because of the opportunity that should come in the near future on those positions. So chances are today you're going to see some new positions added in Baidu because we finally have waited to a period or a point where, well, we've waited to a point where I finally thought, hey, we seem to be at a bottom. We seem to be at a position where we have an opportunity to take advantage of a chart position on Baidu that that shows us where we need to be. So I really need to do this for everyone. I can't just do it for myself. I need to do it for everyone, or wait, 5 days before, 5 days after. So that's our expectation. We're going to get that taken care of today, and we're going to see if we can't make some more money on Baidu like we have in the past. Any questions I can answer for you guys? Any questions you guys have that me showing you our process, showing you what we're looking at, showing you why. I'm trying to be as open book as possible instead of just saying, it's just what we do. Don't bother me. Any questions on what we see here? William, thank you. And Mary, thank you as well. I appreciate both of you thanking me for understanding what we're trying to do and what we are doing by way of research for your accounts. All right, guys. Hey, have a wonderful weekend. I appreciate you guys being here with us. Because this is an actual trade, we probably will not have this posted until tomorrow. Thank you, Jim. I appreciate it very much. Guys, have a wonderful weekend. I look forward to hopefully a big rise here in Baidu in the near future. And now you understand what we're doing and why and how we've come up with our target numbers using PEs and earnings per share next year. Now you're better understanding of how we calculate our numbers to help you understand why we talk the way we do about certain positions. All right, guys, have a wonderful afternoon and weekend. I will see you guys on Monday. Bye-bye.